I'm gonna say it just like you.
Stock market in 50
Just
years.
like you. Ready? What's going on, guys? You're right there. I can't. Oh.
You can say it slow if you want to.
I'm gonna sound so stupid. What's going on, guys? Welcome back to the channel and welcome back to the worst stock market in 50 years. Jesus Christ. That was terrible. Terrible.
Buzzer out, ladies and gentlemen. Welcome back to the channel and welcome back to the worst stock market in over 50 years. Yes, that is what she was trying to say. We'll give it to her this time. She tried her best, but she gonna do a little bit better next time. She finally understands the appreciation of how hard it is to sit here and talk to a camera without someone else responding to you. It looks a little bit easier than it actually is, but nonetheless, guys, that was on a joking matter. If you guys want to hear another joke, this is a picture that I personally just took not too long ago. It says, due to inflation, dirty deeds are no longer done dirt cheap. Sorry. Well, I guess they said it best. And when you got street signs talking about inflation, you got a problem. So we are going to get into all of this key information, something specifically you guys need to know by tomorrow, no matter if this is June 30th, which will be tomorrow. By the time you guys see this video, this information is still very, very relevant and could even be more relevant the day of, because we are getting a data point tomorrow that could give us a big move to the upside or a big move to the downside, depending on what the number is. And we are talking about PCE, the PCE price index, year over year and month over month. If this thing comes in at an even higher reading than what we seen in March, which the high, we'll talk about it. If it comes in higher than that, you're going to see the same market reaction we seen with CPI, how that came in higher than what we expected, the highest reading we have seen, and the stock market fell about 12% in the subsequent, call it about a week trading time. So we got a lot to talk about. The work is cut out for us here in this video. We're going to touch on a couple other things as well, talk about when the markets are really going to bottom, when the markets are really going to crash, and I think it's pretty clear to see right now, and I do want to touch on that in case you guys don't watch another video of mine. Hopefully you can profit from this information given the timeline that is put out here in this video. So without any further ado, hit the like button and subscribe to the channel. If we can get this video to 500 likes, I will have her do a longer intro. We'll figure something out, but hit the like button if you guys want to come trade with me live in real time. Link down below in the pinned comment. Thank you guys for doing that. Now let's get straight into it. So let's not waste time. Let's get straight into it. So the big thing, which is PCE, and the number you want to watch for is going to be this. We're expecting 6.3% year over year. The month over month is going to be important as well. Don't get me wrong on that. But the year over year, why this is going to be so important, and you can relate this back to CPI on 2 Fridays ago. When we got CPI, we were not expecting the highest CPI reading. Everyone thought inflation peaked out in March, and we were very, very wrong. So what happened? The markets tanked through the floor after that, seeing a 2.38%, well, 1% downside move, and then a 2.38% downside move, and then a 2.9% downside move, 3.8% down, and then a 0.30% down move, slight bounce, and then you did see another 3.31% down move. We ultimately hit that bottom at 362.17, but that was an over 12% move from pre-CPI, from that Thursday, all the way down, 12% just a couple short days later. So this can be a very big deal, specifically with PCE. If this number comes in higher than the March reading of 6.6%, we're going to have a real problem on our hands. Now, if PCE comes in at the expected number, which is going to be, it looks like about 6.3%, call it 6.4%, 6.2%, not going to be a big deal. But if you go over that March reading, call it 6.7% or higher, you're going to see a 2 to 3% down day in the markets. That is a given fact. If the markets are down 2 to 3% by the time you guys are seeing this video, by the time the markets open, well, that is why. This data comes out at 8:30 in the morning tomorrow. At the same time, you have personal income month over month for May, as well as personal spending month over month for May, which comes out at 8:30 in the morning as well. And those are going to be very important for the odds of a recession. And depending on all three of these data points, that could really give you a big boost to the upside or a big move to the downside. Now, I don't think if we just come in slightly above 6.3%, you're going to see a big negative reaction. You really have to see a peak, or I shouldn't say a peak, but a higher reading than that March peak that we thought we seen on all of these different metrics of inflation. So if we come in at like 6.4%, yeah, you're probably going to see a 0.5%, 1% down day, but not that 3 or 4% down day that we seen last time CPI came in incredibly high, right? So I think that is very, very important to actually point out, and I think that's the main thing that you guys need to know out of this whole entire video. And as well as that, just for good measure, tomorrow's Thursday, day after that is Friday. You do have the ISM manufacturing PMI as well. That will also be important for the markets. This has been trending to the downside, so that is a good thing. You know, but if you just get these 4 bad data points back to back to back, you could be in for some real pain. Or same thing, you know, if the data comes in good, then you could be in for a really nice green ride. So there is all of that information. Now, as far as the market crash scenario that I can kind of see playing out pretty damn clear as of right now, I think this headline sums it up very well. It says earnings and profit margins may be the next wave of volatility, says Schwab's Liz Ann Saunders. And why this is so important is the timing of all of these events. So we know the Fed is going to raise rates. It's expected about a 0.5 percentage point coming July 27th, right? Well, July 28th, the next day after that, you have the advanced estimates for Q2 GDP, when the markets might finally realize we are in a technical recession. And then what do we have in between, call it July 25th and really the start of August? Well, you have Apple earnings coming out, you have Microsoft earnings coming out, you have Google earnings, you have Amazon. All of these large companies will report earnings in that couple day period. So if you see bad earnings, if you see a technical recession, at the same time the markets, like I said, they're going to realize the Fed is raising rates during a recession, doing quantitative tightening at the same time inflation is over 8%, well, you could make for a real market disaster. Add on top of that, call it the cherry on top of the sundae, or call it the whipped cream or the sprinkles on top of the ice cream, baby. You got margin debt that has only went down about 15% for 2022 from January until the last reading of May that we got. At the same time, the NASDAQ is down about 30%. So you're really looking at a potential shit show for the end of July, for the beginning of August. And that comes with a little bit of good news, because after we get that downside move, after we flush out on the S&P 500, I would estimate, like I said, between, call it July 25th and call it August 15th, once we see that real big downside move, I'm like 85% confident this is how it's going to play out. I can't be 100% because I've been wrong about earnings last quarter. I thought they were going to look bad last quarter. Some did, some didn't give us that, you know, big market move to the downside that I was personally expecting. But I do think that will be in this quarter. Once you get past that flush out and once you see those margin calls, some hedge fund bankruptcies, that's where you can finally mark a bottom, in my opinion, around 330 to 300 on the S&P, and finally start to make our way back to the upside. Potentially the pain could be over sooner rather than later, but there is going to be more pain before it's inevitably done. And why I think earnings will be so important is because analysts have not decreased their earnings expectations. So analysts are still expecting record earnings for 2022 in a period in time where companies are laying off workers. People are fearful. They're not spending as much money. I think just from the picture I showed you guys in the beginning of this video, you can tell people are worried about inflation. They're not spending as much, and we are likely already in a recession. So you mix all of these factors together and you could be in, again, for a real shit show the end of July, beginning half of August. But that is really the time you want to do the most buying, in my personal opinion, and that is where you're going to set up your financial futures and take full advantage of the rally once we do get it. So that is pretty much going to be all for this video. Hit the like button and subscribe to the channel if you guys found value out of this video. Come join the trading community if you guys want to be a part of all of the action over there, link down below in the description, and get yourself those free stocks with Weeble, Mumu, and Public. Even my girlfriend did it, so I'm sure you guys could do it as well. Thank you guys for watching. I will see you in the next one.